All views, opinions, and comments expressed herein are solely those of the speakers and do not necessarily reflect the views or opinions of StoneX Group Incorporated and or its subsidiaries. This content does not constitute an offer or solicitation to open a trading account, to trade in any specific product, or to engage with any services provided by StoneX Group Incorporated or its subsidiaries. This content is not intended for residents of any particular country or jurisdictions where such content is prohibited.
Welcome to the Trading Global Macro podcast from StoneX. We're here to unpack the complex forces driving global financial markets. I'm John Kicklighter, Global Head of Content at StoneX.
And I'm Matt Weller, Global Head of Research for StoneX's self-directed brands. Each week in this podcast, we discuss the macroeconomic trends and geopolitical events driving forex, equities, commodities, interest rates, and more. John, what is our topic this fine day?
I think a topic we discussed is one that we usually come upon, whether it's from people that have been trading global macro perspective for a long time, or especially when they are newer to the theme. But it's the misallocation of correlation to an assumption of causation. Correlation is not necessarily causation. So I think we need to go through a little bit of a definition of the two so that you can understand what we're trying to get to. You want to take that on, Matt?
Sure. So correlation, as any Stats 101 class will tell you, simply shows over a period of time how two different variables, for us as traders, two different markets, have moved together. So it's something that characterizes whether different price movements, for example, were above or below their average over a period of time. To your point, John, it does not tell you why that happened, whether it's likely to continue, whether one is causing the other is causing the first one, or something else is causing each of them, or whether it might be completely random. And I think that's why it takes a little bit of perspective here to identify these correlations, because it's easy to drift into a situation where you see two markets moving together, you assume one's driving the other, and use that to inform your trades. That can be useful at times, but we want to kind of delve more into the details of when that can be useful and how you can use it in your own trading and investing.
Yeah, and I'd add to that you want to avoid assumption of causation when you find these correlations, because humans are pattern recognition monkeys. We are really good at finding these relationships. Even if they are not necessarily ones that are of substance, we will still find them. And then an assumption is cast, and we are surprised when they start to deviate. I've seen this happen a lot. So you want to be able to look at that correlation that you come across and figure out, is this really truly a reflection of something that they're both being driven by, or is it just a happenstance that will eventually start to deviate? Because if you assume that they're related and they start to deviate, your intentions, whether it be an outright trade or investment opportunity, or specifically if you're trying to assume a hedge, are going to start to fall apart. And that's going to lead to potentially significant losses. So you want to be able to be comfortable in saying this is actually causation. This is there's a reason that this relationship exists. And it'll also help you when those reasons change. Your assumptions of those relationships can change, because they probably will. Markets are individual. There is changes in capital or changes in the capital market, and inevitably things do shift. So being on top of why those ebb and flow is really important. So let's talk a little bit about those uses. What kind of uses do we have for these correlations beyond just avoiding unexpected risks?
Well, you alluded to one already, and I'll tackle a couple and then kick it back to you. But one is for hedging purposes. From a longer-term investor perspective, even some cases as a shorter-term trader, you might have a position that you want to hold, but you also want to hedge a risk of something that could negatively affect it with another asset, another trade that could appreciate in that case and overall lower the risk of your portfolio. So being aware of assets specifically that are negatively or low correlated can allow you to sort of improve an overall portfolio of trades or investments. Another way you could use correlations in your trading is as confirmation. For example, if you're looking to trade a breakout in a certain asset, you could look at other markets that are historically correlated with that and see if they're breaking out too. If they are, you might have more confidence that the breakout in the one you want to trade is legitimate. But if the other assets aren't breaking out or moving in the wrong direction, again, there's more nuance into what might be driving that, but that at the margin might push you against taking a breakout trade there because some of the factors that would support it and continue to drive that trade may not be in place. So those are two that I think are useful across different timeframes. One I know that you're really focused on, and I think you do a great job with, is using correlations to kind of derive the underlying narrative that's driving markets. Could you speak a little bit more on that, John?
Yeah, I love correlations because they really do confirm to me why two very different markets would be aligned. Whether it be a positive or a negative correlation, I mean, traditionally, you can think of, we like to think that they're moving in lockstep, but really, you also need to see when things are moving in inverse to each other, because that is also a consideration. The traditional one is like the VIX versus the S&P 500, because naturally the VIX is derived from the S&P 500 options, and subsequently it is supposed to be inversely related. So if I were to look at, let's say, the VIX flipped upside down, it should actually look a lot like the S&P 500, which it does, generally speaking. However, using that same example, it does confirm to me there's a little bit more inside baseball and why I'm a little bit more of a finance nerd. The correlation between the VIX and the S&P 500 is not always great. It's actually been diminishing significantly over time because of the derivatives and the trading of derivatives and the volatility, the VIX product itself. So you can not that a lot of people would actually look for this unless you're going to very specific types of trading, but you can confirm these fundamental narratives using a correlation like this, or in this case, a diminishing of the correlation between them. But there are many different relationships that we can see that if I wanted to say, all right, what's driving the dollar, I can actually look at a few different components, because there are larger themes, and knowing that that driver, that consideration of what's really motivating the dollar up or down, can really give me a sense of not just what can continue to influence the dollar, but it can also tell me maybe there is a bigger shift in risk trends, bigger shift in interest rate expectations, a bigger trend in just a general alteration in the confidence of fiat assets. I mean, there's so many things you can actually look at, and there are a lot of trades that can come out of that theme. And looking at a benchmark inversely can allow you to trade on the theme and not necessarily the asset itself. So I like a lot of the fundamental narrative of these relationships of these markets. It's probably one of my favorite. And I also use correlations as systemic insight. So you're very familiar, Matt. Like when we have a significant rise or fall in the benchmark capital markets. So when you're using something like the S&P 500, which is often used as kind of a benchmark, the question quickly becomes, is this a true risk on or risk off move? And the reason we ask that is because risk on, risk off is systemic. It knows no bounds within the financial markets. It can spill over to all asset classes, really aligning them to either being a risky asset or a haven asset. And when you see that true fear, like we did back in the pandemic, or when we did back in 2008 with the great financial crisis, that becomes a situation which we say correlations go to one. So if you ever hear people say when correlations go to one, or they are going to one, it's usually just a finance way of saying risk off is extremely strong, and it means there's panic. So one of the best uses of correlation, and you can look at a suite of risk-oriented assets, equities, nowadays crypto, you can use emerging market assets, high yield fixed income, a laundry list of them. And when they are all aligned, there are a few other explanations that are better than saying that there is true risk on, risk off. So those are a few real world uses, but also I think we covered a couple of cases. Let's talk a little bit about a few more real use cases of correlation and how we could use it. So what?
Yeah, I'll step in here and kind of tackle the classic portfolio management 2011, which is just stocks and bonds, the kind of cliche A long-term portfolio might be something like 60% stocks, 40% bonds. And the idea there is that to an extent, they hedge each other. In normal environments, your stocks might go up by more than the bonds, but the bonds also go up. And then also, if you're in a growth scare, if the economy is going into a recession, that's where stocks tend to fall more. Bonds, it's a contract. You're getting your, in this case, 5% on the 10-year back at the end of the contract. So in that way, you could, for example, rebalance away from the bonds and into the stocks and have a lower overall volatility, maybe a better return profile for your portfolio as a whole. This is where the nuance comes in, though. Well, bonds can hedge stocks from a growth scare or a recession, if you will. They don't necessarily hedge against inflation. And present situation notwithstanding, a lot of times inflation can weigh on stocks too. So you're hedging one risk, but at the same time, by hedging that risk, you're almost taking on more risk for your portfolio to an alternative risk, the risk of inflation, wherein rising prices eats away at the principal of your bonds, and you get a very low real yield from those, maybe even negative at the same time that can, in certain environments, weigh on stocks. So you have to kind of understand which risk you're seeking to hedge, not just assume, hey, I've got this diversified portfolio that I read about 60-40, I should be good forever. Well, there's kind of a missing blind spot there, a risk that perhaps people hadn't been considering as much until the last decade or so. So that's one that comes to mind for me. I know you have some more nuance around the stock market and the US dollar and just broader ways that the US dollar can be used in correlations in markets.
Yeah. So I actually like to use, and again, correlations changed to your point. I mean, it's really interesting you to use it as a verification of what is driving the markets fundamentally. So when we have the dollar, which for those who are watching, I have it here in blue, and then I look at it relative to a few other benchmarks, it can tell me and help me identify what kind of major theme is driving the markets, because there's always competing themes. It's very, very difficult for us to know exactly what is moving the markets. You can't take a survey of everybody across the markets and saying, oh, what's your motivation, and then distilling it down to see who has the most votes, or what theme has the most votes. So using correlation across key benchmarks can help. And I use this very frequently in the dollar. Now, I don't use it on a daily basis. I use it on a much higher time frame, like weekly or monthly. But I like to see what is motivating something like the dollar, where it's the most heavily used currency across the world, and subsequently, thereby, it's a nexus of many different fundamental themes. So, if I were doing that, in the case of whether the dollar is going to be treated as more so a haven, a dollar versus something like the S&P 500 as a risk asset, it usually stands on the spectrum as a haven. So when we have severe risk off, so if you've ever seen a stock market crash, what happens to the dollar? It's usually going up. Why? Because we're taking that money out of capital assets and we're actually putting it back into our local currency. And obviously the US does it, and people in different countries will go into the local currency. But even in a more intense move, you will see it going from, let's say, yen or euro or a cable back into the dollar. And that's because you're not really stopping at the dollar. You're buying dollars to buy treasuries because you're really looking for safety. So when you see that correlation really intensify, it suggests to me that there's a severe risk off. If the dollar is rising while the stock market is dropping aggressively, if you have a strong negative correlation, it's usually an indication of a very intense risk aversion. But that's not the only thing, and often we're not at that severity of a move. So more often than not, we're looking at something else that's driving the market. I think a popular one that we can talk about nowadays is people referencing the anti-fiat of the dollar. So if I were looking at, let's say, gold, if you're looking for an alternative to the dollar, it's going to be very difficult, and that's a whole other different discussion. We won't go down that road. Maybe another podcast episode. But to get away from the dollar, which is what I think the BIS said recently was 88% of all use is in dollars of the major currencies. So you can't really get away from it. But there are at the margins very strong anti-dollar or pro-dollar kind of views. So if you're trying to find an alternative to the dollar, where you go, well, there's not really anywhere else to go. Euro maybe, but also gold. So aligning it to gold, and when those correlations are strongly negative, and you have to consider that gold is also generally priced in dollars, so as to be out of the ordinary. You can do some things like looking at gold and euro, for example, but that tight, strong correlation will lead you to that theme. Oh, maybe there is a strong anti-dollar theme. Let's say like there was back during the height of the Liberation Day tariffs. There was a very strong anti-dollar view, and then there's even a third one. We can look at something where the dollar plays carry. Now this will change naturally because, and we can look at something like the Aussie USD. Now again, the dollar is a component of that, but the Australian dollar, historically speaking, through the length of how long you and I have been doing this, it was more of the Australian dollar is a carry relative to the dollar, which is a funding currency, so it had a lower yield. And if there's a very strong or negative correlation there, then it's usually a good sign that there's a strong appetite for higher return assets. So it's a carry trade. Now, these three themes are related to each other, some spillover, but seeing at which phase we're in, and again, using the dollar and its relationship to some of the key benchmarks is not necessarily just a setup for me to look and see how I want to trade the dollar. You can also be saying to me, I need to change my approach to the markets because these themes are shifting. And knowing that can be very, very useful, especially when you're trying to assess when we're in a full scale risk on, risk off, because that has a tendency, a dramatic move, an all encompassing move, and it has more sustainability, which is what you really want to look for when you're assessing your markets. All right. So those are real world use cases. From your perspective, which ones can be misleading or are controversial?
I mean, it really depends on the environment. I think that's my overarching message that I want to convey here. One that I can double click on right now. And as you know, John, I've done some work on just over the last couple of months creating long-term currency fair value models that look at some of the factors that drive currency values. And yeah, they obviously fluctuate up and down around those, but what kind of drives those over the longer term? And I created a number of models for all the major currency pairs. And the one that stood out was dollar yen. Based on my fair value model, it suggested dollar yen should be trading closer to 130. It's currently at 160. That's a big divergence in the currency market for those of you who don't follow it that closely. And that puzzled me, at least for a period of time. And then now that I've thought about it a bit more, read some more, it's because one of the key factors that went into this value, something that is historically correlated with currency values, is interest rates, the sovereign yield of Japan. And I think the point is most clearly made with the 10-year yield, but either way, the yields for Japan in particular are artificially low. That's because the Bank of Japan and Ministry of Finance are aggressively buying in the market. Buying bonds suppresses yields. So they're arguably not trading as high as they would in a free floating market. And because they're trading at that level, that suggested that the yen perhaps could be stronger. However, that it's kind of a teeter-totter scenario where Japanese authorities are suppressing yields. Well, that leaves the yen as sort of the pressure release valve, and that's why the yen was weakening so much. Now, in our current environment, we see that it's weakened too far for Japanese authorities, and they've started intervening directly in the yen. And I think just today, as we're recording this here on the 14th of May, 2026, long-term Japanese bond yields now are rising. So that gap is sort of closing as the massive $5 trillion a day forex market and however many trillions flow through the bond market are sort of overwhelming these token efforts by even an entity as large as Japan as a country and its entire financial system. So it's a correlation that, honestly, I'm not even sure it fits in this category. It's misleading that it wasn't a correlation when you look at yields and the value of the yen. But now that's starting to close, perhaps suggesting that you can only deviate from some of these correlations for so long. So that's a deep dive into one here. I'm not sure if it strictly fits the category, but I think it's an interesting discussion that really encourages looking at what are the factors driving these and are they legitimate? Are they actually representative of what's happening in the underlying economies? I've got a few more, John, but I'll kick it to you after that long diatribe.
Yeah, yeah. And I mean, there's a lot of standard ones too. I mean, this is a good one because fundamentally, there are times when, yes, that relationship does matter. But going back to what I talked about the dollar, fundamental themes shift, so the correlations can reasonably be expected to shift as well. And I think there's similar, and we don't have to go into them, but dollar CAD and oil. Historically, you and I have written a lot of content on this. I think gold and Swiss franc. We've written a lot of content on this. I think that those are really well known and in the space if you've been here long enough. But those relationships do change over time. And I still see content out there that really says, "Oh, you can't trade oil. Why don't you go trade the dollar CAD?" And people are trying to still drink it that well, even though that relationship has really diminished because the U.S. is a major exporter of oil, whereas historically it was Canada that was the exporter.
Mhm.
But I think I'm going to my suggestion of a misleading or controversial one is probably going to upset some people, but I'd like to tackle the Bitcoin relationship. So. Bitcoin roared onto the scene, obviously, and the selling point for it and crypto at large and decentralized markets and being able to leverage outside of the influence of a government or governments that they have their own interests and globally that can misalign things and create volatility, tension, and there's the utopia of Bitcoin as the leader of the crypto market. So it was treated as if you will, an alternative to a traditional fiat. So we won't, dollar is the benchmark, but you can also say align that to gold because how often did we hear it be called the digital gold? But in reality, was it really digital gold? And I don't think that it really. You and I were talking about this a little bit. It never really stood up to that role. It was sold as digital gold or an anti-fiat, but I think the controversies which you've made a lot, I've made a lot, when we've talked about. There's no way governments are going to allow you to just be able to interact in a crypto and avoid paying your taxes. That's just not going to happen. So the allowances of crypto from what it was intended to be are certainly changed a lot, and the relationship that we expected to align to gold have really, especially of late, fallen apart. Those the strong expectation of correlation has fallen apart from gold as another anti-fiat. But you can argue that gold itself as an anti-fiat has been distorted because it's been trading recently as a kind of a safe haven, or sorry, a risk asset, whereas it also as a safe haven. So again, these correlations, you really have to pay attention to and explain to yourself why this correlation or the fundamental theme behind it. But I think that much more reasonable nowadays, and I would argue has always been the case, the relationship between Bitcoin and something like the S&P 500 is stronger. And that's because crypto is more of a new market. New markets, when they're emergent, there's a lot of capital that flows into it because people are looking to take advantage, are looking to take advantage of it as a fiat, or they're trying to use it as kind of the plumbing of the financial system, and it's just emergent. Well, a lot of those people get in not because of the slow, meticulous way that the markets will move and really fortify the financial system. They're really just trying to get in because they think that everyone else is going to have to get in too to have exposure to it. So they're just trying to buy low, sell high. So that's a speculative drive. And not to say that Bitcoin doesn't have any value outside of this, but it certainly does. But a lot of people will treat it as a risk on, risk off asset. And that's why you have a stronger correlation in recent years between Bitcoin and something like the S&P 500 than you do to gold or dollar or any of these other types of things. So again, a misleading or controversial correlation. A lot of assumptions and a lot of selling points and marketing material have been made around. But if you really dig into it, you start to see something a lot different, and it tells you about the market. All right. I think we covered enough for today, so I think we'll just wrap it up there. Thanks for tuning into the Trading Global Macro podcast from StoneX. If you enjoyed today's discussion, make sure you subscribe to wherever you get your podcast. I'm John Kicklighter.
And I'm Matt Weller. Join us again next week for insights into the trends and events driving global financial markets. Thank you.